Hey everyone, welcome to Dr. Frank's Finance World. I am Dr. Frank, the bank, where I try to teach you something about finance so you can make more money in the future. This is part 4 video of forming portfolios. It's pretty fun because I'm going through the analysis of the university I was at before, where I kind of brought a dormant student fund back from the dead and was able to set up the criteria and what they did in order to, I thought, do well and perform. And we actually went to a national competition called RISE, which was up in Dayton, Ohio. They've moved it now to New York, but and we won the top performing portfolio in the country. So I think it's a process worth paying some attention to, and that's what we're going to be going over today. So please, if you like what you see or hear, subscribe and hit notifications. Look for notes on the links. We got to get better at filling that in. But also the bookstore is out there as well for Dr. Frank's Finance World. So Henderson State University, the process, and it will take the entire time. This was kind of our creed down there. It's all about the alpha, with alpha being outperformance. So let's get started. So here's what it looked like when we were doing it way back when. This is a decade old now, but I did Caterpillar for them, and I asked certain questions that I think investors should ask of themselves before they actually get investing in the world out there. So like most presentations in the finance world out there, you tell what the current price is and whether you would buy or sell it or keep it. It's basically hold or buy, hold, like their recommendation. And then tell why you came up with a price that was $20 above where it is now. This is 3 big questions I always wanted the students to ask. What do they do? Sounds simple, but answer that for any other major company out there, Apple or Walmart or whatever. And I think you'll find out that there's different segments of what they do, and that's why we break it down by segment. How do they make money? That's the big one right there. Are certain segments paying off? Are they not? Is one area growing that's more or less profitable? And just bottom line, how do they make money? Because for me, at least, if they're not making money, almost without exception, I don't buy the company. And then finally, who do they compete with? We can think of John Deere and some of the others as competitors to CAT. But, and like I said, keep in mind, this is a decade old, so this is in no way a recommendation now. It's just discussing the process. But by looking at who they compete with, you can start to figure out from the SWOT analysis of some others whether they're actually going to do better than the competition. So what drives better results? For this company, it was better margins because of better and more specialized projects. And so they were able to charge more for the stuff that was not just a drive around your lawnmower. So what do the investors care about? They did have a 2.4% dividend, and they were looking at building out worldwide infrastructure. That's what Caterpillar does, big earth-moving machines. What has the potential to affect the stock prices? Obama was in power at the time. Any president is in power, what their policies are towards rebuilding airports and roads and stuff in America, as well as the growth of China as well. And then, of course, just recessions and government cutbacks, and then establish either a bull or a bear case, with a bull case meaning, hey, buy it, and that would be the case here because you expect the price to be higher, as opposed to a bear case. Sometimes when you go through all the analysis, you still come up with a price that you expect to be lower than it is now, so that would be a bear case. We looked at some basic information. You get this off of Yahoo. Out there, Yahoo Finance, you can pull all this kind of stuff. Just kind of seeing, are they on the big exchanges? I like to see how many employees they have, because that it's a lot less likely they're going to go out of business if they have 132,000 as opposed to 130 employees. Anyway, book value, one of the anomalies we have talked about or will talk about the firms selling close to book value tend to do better, and the market tends to have about 5 to 6 times book value, so they're selling at about 3 times book value. You take the price and divide it by the book value, so it's somewhat cheap. It was trading more towards the lower end, or maybe the middle part of the 52-week high and low. Just relative change to the market. That's a 52-week change, but at the time, Caterpillar had underperformed the market by 18%. This goes back to the regression to the mean. Stocks that outperform for a long time typically don't do so forever. They really can't. And stocks that underperform don't typically underperform forever either. So the regression back to the mean becomes a pretty big deal. Hold on a second. When you're looking at the size of the firm, anything above 10 billion is technically known as a large cap, and they tend to have slower growth. Beta, we're going to use it in the DCF model that we've gone over before. You can see this one actually moves quite a bit relative to the market. And the earnings per share and the price to earnings ratio. I like low price to earnings ratio stocks. You will tend to find lower ones in businesses like mining and construction. So don't immediately get all excited that it's low. It might still be high, relatively speaking. And this PEG ratio goes back to Peter Lynch, where you don't want to pay more than twice the growth rate. You're paying half the growth rate out there from price to earnings ratio. So anywho, business synopsis, they did large equipment, global and so forth, the large producer of moving equipment. Foreign sales are 70% of total. So they're going to move more like the Dow Jones, where a lot of their dependency will be overseas markets buying their stuff, and they will be more impacted by movements in the dollar. Products include tractors, scrapers, all that kind of stuff out there. They have major global markets, include road building, mining, a big deal out there, logging, agriculture, petroleum and general construction, produce diesel and turbine engines, as well as transitioning to natural gas even a decade ago. So this is the valuation that we used to do. It's very similar to the DCF. We did this one when we were at Texas Tech University, and there is the current 10-year bond rate. Historical, you can see, was quite a bit higher. You're going to use that bond rate as a risk-free rate in the trying to figure out what the required rate of return should be, and that's what we have up here. The common stock return had been pretty high at the time, 13.3%, and so forth. We hadn't had some of the times we had recently, but at any rate, so when I did the 1 plus the 13.3 times 1.055 anyway, we came up with a cost of equity of 7.39%. And when we put that into the formula over here, I guess actually we're calculating the required market return, but we end up with a 7.39%. Very common. Usually you run 6 to 7, maybe 7.5% for what you expect to earn on stocks in general. And when we multiply it by the 1.82 and add the 10-year risk-free rate, we're saying that essentially Caterpillar needs to earn 15% a year. Pretty high return for a earth-moving equipment company. So there's the current price. We're predicting a year from now the earnings won't be much higher, or the price to earnings ratio. That's the current earnings per share. They are paying a dividend. There's the growth rate and dividend. The growth rate and earnings per share was expected to be quite a bit higher because we were heading into a cycle of more fixing things and that type of stuff. So that's the dividends you would make in a year. The present value factor is simply going back and saying if we're looking just 1 year out on the DCF, and we expect to earn 15.13%, let's just say, essentially $1 a year from now is only worth 86.85 cents today. So this is a little bit of a reversal of the DCF process, just saying, if we're going to do a price to earnings times a future price and figure out what it's worth a year from now, what is it worth today? We're going to multiply that by this number right here. So anyway, to get where they were valuation wise, the earnings per share was right this, we expected to go that. So 1 year from, or grow at 21%. So 1 year from now, that should be earning $11.69. When we take $11.69 and that future PE, this is the future price we're expecting. So we take the future price plus the dividends we earn, divided by the current price, and you see that it's supposed to earn 1.2576%, or about 25.7%. And since the required return was 15% up here, I think. And it's going to earn 25%, this is going to be a better than average stock. So we say it's worth $95 or $95. I'm sorry. It's selling for $8.87. So therefore we think it is worth that and selling for that. And it is therefore undervalued. We always looked at it from a technical analysis standpoint as well. It was sort of middle of the range, so you didn't get a lot of information from this. But, if it was way up here, we would probably think twice about buying it right away. But at any rate, that's just adding technical analysis at the end. I just had a really good discussion with a large mutual fund company that we work with a lot about whether they use technical analysis as sort of a final input, not necessarily the deciding factor, but an input. And they said, yeah. So I think that's kind of interesting too. All right. So the problem is in investing is you say, well, this number is good and that number is bad, and this number is good and that number is bad. And so I'm going back to the Petrosky research, basically, and saying I'm going to give them a 1 if they have a PEG ratio under 2, for instance, and a 0 if the PEG ratio is over 2. And this allows students to sort of add up the ones and zeros and see if you think this is worth buying or not. If it was middle of the range or above, you'd probably buy. If it was towards the low end, it means it's probably expensive in a number of ways. So the book value of 3.16 is less than the S&P. Like I said, it runs about 5 or 6 times. So that was a 1. The relative performances it had underperformed, so I'm hoping that regression to the mean is going to work in favor of that. So that was less than the S&P, and so that's a 1. Industry rank was just above that 40 mark. You could take it as a 1 or a 0. We used the industry rank from Value Line, and if it was greater than 40, 40 and below, if you want to think of it that way, we gave it a 1. Otherwise, we gave it a 0. This was essentially 40. I probably would have given it a 1, but I wanted to differentiate that for the students. It was sector rotation wise, we were expecting an up market, and it was 6 out of 10, so it was in the bottom half. And this is what you expect from Jeff Mercer's research. I hope you see how we're doing this. We're putting each factor that we believe matters from Jeff Mercer's research to the value line to regression to the mean to the anomalies like market to book and PEG ratio. And we're saying, is this factor in our favor or not? The whole purpose of all this was essentially to try to own stocks that had more things going for them than against them. So that was a 0. Bottom half, if the economy had turned down, that would have been a 1. The beta was quite a bit more than 1. Since it's more than 1, it's expected to be more than the market. We were expecting a possible down economy going forward, so that's a 0. The dividend yield was average slash, it's an average or above dividend yield. The average dividend yield, if you take the dividend divided by the price, for the S&P 500 is about 2.2 to 2.3% typically. So the payout ratio is something when we get to the accounting part of the worlds out there, we're going to talk out there. But basically, to make the 2.4% dividend happen, Caterpillar was only spending 21% of its net income to do that. So this is a very supportable dividend. The cutoff for me on payout ratio is something below 50%. So if they're paying less than 50% of their earnings out to cover the dividend, and it's an average or above, that's actually a positive thing. It was near its low, basically closer to the low than the high, so that was a 1. Market cap was above what I typically like. I don't like to get more than 30 or 40 billion in market cap, which is almost a mid cap these days when you have these $1 trillion companies. But it was a little high at the time, so I said that wasn't good. And debt to equity was quite a bit higher than what you would see out there. Not for the industry. Everybody had that in the industry. I mean, obviously it's metals and mining, right? And you produce really expensive equipment, so they typically are in debt. But, it was above what we could buy the S&P for instance, so it got a 0 on that. The Value Line safety rating was 3 or above. Value Line does a great job of analyzing the financials of companies, and so we said that was a good thing. So in the end, what you got was 6 or 7 out of 10. Since it's above sort of the midpoint of 4 or 5, maybe 6, that's essentially this would be a stock that would get the thumbs up from us. But I love how we sort of figured this out, if you will, how to see the variables and how to sort of put them together in some type of system that allows you to see and say whether maybe this is a buy or not a buy. So it would at least be a keep or a hold. What are their strategic advantages? The only one in the world who's ready for the build out. Nobody else could do it at the time. There have been some Asian companies now that have built enough that would be competition for it, but not at the time. Any channel checking? They are working 4-day work weeks at the production facility. Channel checking means you go see what's going on at the company. I had a student whose husband worked there, so we asked about what was going on there. That was that's a positive thing for workers, but usually means you're not crushing it as far as numbers. So sort of middle of the road. And then how would they do in a political environment? Probably better with Romney than they would with Obama because he's, in theory, Republicans are, more business friendly and so forth. But no big deal one way or the other, to be honest with you. So that's what we did at Henderson. And the other total, we went to Dayton 3 years in a row before they actually moved it somewhere else. And when they moved it somewhere else, we couldn't travel. I couldn't drive there anymore. But in those 3 years, we finished first once and second twice. So a pretty successful method. The books I would suggest, going back and looking at 5 Rules for Successful Stock Investing, Pat Dorsey, great research guy. He works at Morningstar, was in charge of the stocks and all that kind of stuff for a long time. Some terrific information in there. The New Money Masters is one I've always enjoyed by John Train. He talks about, all kinds of different investors, Warren Buffett and Peter Lynch and a bunch of others in there. But, what do they say is important? Even George Soros is in there as well. But what do they say is important? Not really any research on foreign portfolios, to be honest. And just as a last strategy tip, what we did is we always started with the top down. We looked at the economy and what the Fed was going to do in the government, which is sort of top down. We used Jeff Mercer's research paper on that, then did our discounted cash flow and multiples analysis, kind of like you see up above there. We layered a little bit of technical analysis just as a thought, but not as a deciding factor, but not a primary driver of the portfolio. And then we had either a buy or hold or sell. So don't forget, send emails if you would, please. And especially if you have some questions for Ask Dr. Frank. Well, have a great day. We appreciate you watching. We'll catch you later. Bye-bye.